Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm your host for about the next 20 minutes here on Options Guide TV. All right, here we go. Well, the USO trade, I don't know if we got lucky or if the charts actually foresaw that there was going to be an event, but haven't looked at oil in a while. And actually, I saw somebody highlight a chart movement on X.com, and I kind of looked into it and I thought, yeah, that looks interesting. And the day after we set up our trade, we had the geopolitical event over in the Middle East. And since then, oil has been volatile as far as the price is concerned, but ultimately the price of oil is going up. And the conflict is still existing. It's not like it's going to go away tomorrow. I think that's the interpretation that we're getting from the price of oil. And because of that, we did put a short put spread on. But it's interesting to me, and I'm going to highlight, and we're going to go there in just a second and talk a little bit about the prices and strategy, is that the short put spread is really not giving up a lot of premium. It's very sticky, and then that's mainly because implied volatility is going up with it. But then we bought a long call option, and we bought the 90 strike call. So I would think about getting out of that call, because that's just quite a long run for the USO to get up towards the 90 level. Right now it's trading at 81.05. Since we put the trade on, it's up 7 points. And I just like letting the short spread, work its way through and try to get a little bit lower value to be able to close the short spread. So let's go to the what if calculator, and that's where we're going to start. We're going to start with the short put vertical spread. All right, highlighting that right now, and we're going to let's send this one to the ticket, and you see that the markets first of all got wider. USO usually has fairly liquid markets, and it's part of the reason why I like to trade it. There's also a USL, which is a little bit more long-term price of oil, because all of these are based off of the futures, and because of the USO and the shorter term duration of the contracts that they're trading, it's a little bit more volatile within the price, but the options trade much more are much more liquid, and I just think that it's better known. It's the symbol has been out there a lot longer than the USL, and because of that, and even all the way back to, if you can remember, all the way back to the first Trump administration, we actually had a situation where the futures contracts actually went to negative for the first time ever. If you had a barrel of oil, you had to pay somebody to take it from you, which is counterintuitive. But bottom line was, especially on the WTI, which is refineries and physical, where they store there weren't tanker ships, if I remember right. Gosh, I'm botching it because of everything that happened. But if you remember, the actual price of the futures went to negative, meaning that if you had a barrel of oil, you had to pay somebody to take it from you. And USO was traded very heavily back then. Markets were real tight at that point in time, but I don't know. I don't know if anybody remembers that. That did happen, and I won't forget it. That's for sure. I don't think it will ever happen again. But in this instance, so the trade right now is at 81.16. To go back to this, market is right here was 72 is what we sold. So here's the strikes. We did the July 11th expiration, and remember this Thursday is the markets will be closed. So there's also going to be the 4th of July in the middle of this. So there's a lot of holidays that are happening between now and then. And then we sold the 72 strike put, and we bought the 65 strike put. And right now, if we look at this position, that's trading for 81 cents. Now, we put this on for about $1.60. So we're we have we've made about 50% of the premium at this point in time. If whenever I'm doing short spreads, if I can get out with 80% of the net credit received, I'm almost always going to do that. It really depends on where the market's at and where we are at with the expiration date. But right now, with plenty of days until expiration, we'll run over to the chains and kind of take a peek at things. We have 23 days remaining to expiration. If I could close this out and I could end up paying, let's say 30 cents for it, I would do that. So right now, for this week, I would put in a buy to close. I'd flip the script and try to close this out and have a standing order to close it out for 30 cents if I could. And then if I can't get that done at that price, if we don't get that type of movement or that type of time decay or just implied volatility settles down a little bit, then I would look to probably close it before the weekend. I don't want there's obviously very heavy news cycle that's going on, and who knows what will happen over the weekend. So we got this trade on. We, made money fairly quickly on it. I don't want to lose that. Now, if I did more than one contract, we always talk about a 1-to-1 or a one contract scenario, usually here on Options Guy TV. I'd maybe sell half the position and then let the other position ride. And that would be the way that I would approach this entire USO trade. Now, the 90 strike call option, which let's go back to the what if calculator for a second. Yeah, it was the 90 call with that expiration. I'll highlight it. Is now trading for $2.93 by $2.79. So that position, we put this one on. Yeah, we got a double on that. We put it on for $1.40, and we've almost doubled that position. So I would also look to get out of this one too before the weekend. You can try to target something a little bit higher if we're showing a little bit of weakness in the stock, but that's after a big run up in the USO, I should say, the ETN. And so maybe put in a limit order to sell it at 310 possible and see if you get it today. And if you don't, I would look to close it out at the end of the day. The long call has a lot of susceptibility to volatility fluctuations because we are out of the money. Remember, we took the premium from selling the short put spread and bought the long call. And I don't want to lose any of that implied volatility premium that is baked into these option contracts. And you can see it's trading up on the high side. It's trading up around 70. So this is reason. Look at look at these option contracts. The IV on the 96 is 78. So you have a skewing of volatility that is abnormal, where you usually get with on the put side of things too. Let's see what's going on down there. 62, 64. So we have a higher implied volatility on the out of the money calls than we do on the out of the money puts. 77. If we go down one standard deviation, we're at 60. Yeah, that's interesting. That's an interesting vol skew, that's for sure. All right, so I still want to close out the trade. Now, the other thing that's annoying is this option contract, our 65 put, our protection. The market's really wide on it. Look at the 64.5. I don't like the half point strikes anyways, but with that said, the markets are have widened down there, but they're very liquid. So I do think, especially trading it as a spread, that you should be able to fill somewhere close to the midpoint. Do you have any questions on the USO trade? Should I move on? Am I talking too much about it? But the skew is interesting in the volatility. The fact that it's so much higher on the out of the money call options versus, I'm looking right at about the one standard deviation move. That's why I'm highlighting the shaded area versus the out of the money put. So the marketplace seems to be leaning towards the call side of things, thinking that the market would has more, the path of least resistance is still to the upside on oil. All right. Adobe. That's our second trade that we have on. So in Adobe, let's run to the what if calculator. I have the trade set up here. We sold a short put spread, and our scenario was that Adobe announced earnings last week. Their earnings were solid. The company got beat up for it. As a matter of fact, the day after earnings, Adobe was down about 5%. The market then rallied as we began the week, and we had a strong rally to the upside. And now Adobe has given it all back. So bottom line is this position is down, but I don't think I would do anything with the position at this point in time. Midpoint is 478 on it. We put it together for I think it was $3 when we put it on. We got a $3. Well, I have $3.15 in the screenshot, so somewhere between $3 and $3.15. I think it was closer to $3. We'll call it $3. So we're down $1.78 on this trade. The market is right in between the middle of the strikes. I still think that there's some strength in Adobe. If we want to look at the chart, I just don't think it's getting the respect it deserves. I don't know, because people not 100% sure why this stock just it has solid earnings. They even up their guidance. Yeah, we're sitting right at the 50-day moving average. So we want this area to hold. Here was the downturn, broke below the 20-day moving average. Well, let's hope that we get the hold and the support right here. We'll be back on Friday and we'll look at this trade. And if we need to, we'll look to do an adjustment. Now, I wouldn't adjust right now, but here's one of the things that if the market does go down that I like to do, if I paid a fairly decent amount for a short put spread, is roll it into a butterfly. Now, right now, it would be a fairly expensive butterfly because the market moved against you in that scenario. But we're on the put side of things, right? So we're on this side of the chains, not on this side. Market is down. We're down about $1.78 at this point in time. I wouldn't panic just yet. But here's what my alternative would be is you sell the 390, sell another one of those, and buy the 400. Now, we're dealing with wide strikes here, so you have to enter everything as spreads. I'll remove this trade, and we'll see what the net credit would be for that. So we come in, we would be selling this, and we'd be buying that. Oh, we got a net debit. Okay, so if we do in this scenario, we have a $3 net credit that we paid for this. This was $6 or this is a $7 net debit to the account. We'd have a risk of $4 on the position, which is about what our risk is on just overall on the trade. But it would give us the potential that if the market continues on down, this will offset our risk, and we need it to stay somewhere within the strikes by that expiration date. Now, I don't want to do this just yet. This is fairly expensive adjustment to do on the trade, but we will come back and we'll look at it on Friday, and if we need to, we'll look to set that up. All right, so let's look at another trade for the day. And since the markets are closed tomorrow, what I would like to do is just a very short-term SPX trade. So I feel like there won't be a ton of movement. We're really hanging around the 6,000 level, and we're really struggling with it. So I want to do a wider strike butterfly right around the 610 level, thinking that the market might not move over the next couple of days, especially with the markets being closed on Thursday night. The rest of the world has to figure that out. So we're going to do a very, very quick, very, very short will be doing the June 20th expiration, and that happens to be the normal monthly expiration. So that's another talking point in that if you see inside the Tradier Pro software, the chains are laid out very in a real nice format. And we're highlighting that the SPX, the normal monthly XPX, is a June 20th expiration, and it's the symbol's in green and it doesn't have a W next to it. It does not have the weeklies. And the other June 20th has a W next to it, and it's SPX, and the symbol is in yellow. So this option contract is the option contracts that actually trade on Friday. They trade all day Friday, and the settlement price is based off of the close on Friday, where this option contract stops trading on Friday. The settlement is based off of the open on Friday, and the last day to trade would be Thursday, which the market's not trading. So, yeah, that really creates an issue on these option contracts. So you cannot trade. I guess the settlement will just be determined on Friday morning on the 20th. All right. We want to avoid that. That's for sure. Here you go. Here's the June 20th expiration. We'll use call options. We're going to go 15 points. So we're going to give ourselves a 30-point range. Well, the market moved about 30 points today. Yeah, let's do 30. Let's see if we get something to stay within that 30-point range. Hoping the market kind of just settles in a little bit heading into the close. So we'll go down 595. We're going to buy this one, sell 2 of these. Buy this one, sell 2. And then we'll go up 15 points and buy this one. So the entire cost of our 15, let's delete that. Is $1. So we're risking $1 for the potential to make it $1. Let's make it $1. We're going to say we got filled at $1. All right. So a very short term, I guess I'd say maybe try to take advantage of the holiday. It's right here. Zoom out a little bit. We're going to buy, and at the money, we got all day Wednesday, no trading on Thursday, and then all day Friday. That's what this is going to live. We're hope the market stays within the range to start with. We're 15 points to the upside or 15 points to the downside. So going into the close, that would be nice. And if it does, and it opens somewhere close to that on Friday, we can get out of the trade and easily double, if not triple, this position. But we need less volatility over the next couple of days as opposed to more volatility. It's going to be a holiday all day on the 19th, the Juneteenth holiday on Thursday, and just an interesting short-term trade that we'll know the answer about on Friday. So, recap. USO, let's get out of that position going into the weekend. Too much news risk. We got implied volatilities rising. If anything, I might close this trade out and maybe look to do a bull call spread. Do something that reduces our risk. We could actually maybe end up selling our 90 strike call, but I like the skewing of the volatility in the USO right now. So if I got out of this position, took our profits, and then rolled back into a bull call spread, trying to take advantage of the skewing and volatility of the upside on the calls, you can get a fairly decent price for a USO bull call spread. I don't mind doing that trade, but I don't want to do that while we still have our position on. I'd want to take that off before the weekend gets here. But if you can do it today, that would be ideal. Now, on the Adobe situation, we got a hedge that we can potentially do to it to try to turn it into a butterfly, reduce some of our risk. But right now, with the Adobe, I don't want to panic at this second and get out of the trade. The market is down on it, but we still see some strength in Adobe just in general. I think a longer term hold, it's probably a good position for that, but we have option contracts that are going to be expiring. All right. And that's it for today's Options Guide TV. If you have any questions, you can always put them in the chat box. Please check out the Tradier Hub, hub.tradier.com. And yeah, enjoy the Thursday holiday. Very, very nice to have a day off in the middle of the week. And we'll be back on Friday at 11 a.m. Eastern time for the next edition of Options Guide TV. Hope to see you in the hub.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.